On July 27, 2026, the Shanghai Stock Exchange hosted an initial public offering, unlike anything the Chinese chip industry had produced in years. Changxin Memory Technologies, known throughout the industry simply as CXMT, began trading on the exchange's star market at an implied valuation of roughly $85 billion, raising somewhere between $8.5 and nearly $10 billion in the process, depending on whether underwriters exercised their full over-allotment option. Reuters called it Asia's largest share sale of 2026. Other outlets described it as mainland China's biggest listing since 2010. And retail investors in China wanted in badly enough that the online tranche of the offering was oversubscribed by more than 200 times, with roughly 9.5 million individual investors placing orders and only a tiny fraction actually getting shares. This is the story of that IPO, the company behind it, and the uncomfortable question now sitting on the desks of policymakers in Washington, whether years of trying to restrict this exact company came just a little too late to matter. CXMT's story begins in 2016 in Hefei, a city in China's Anhui province that has quietly become one of the country's most important semiconductor manufacturing hubs. The company was founded by Zhu Yiming, an entrepreneur who had previously built GigaDevice Semiconductor into a $61 billion company, and CXMT set out to do something no Chinese company had managed at real scale before: mass-produce DRAM, the dynamic random access memory chips that sit inside every phone, laptop, server, and data center on the planet, an industry that for nearly 3 decades had been controlled almost entirely by 3 companies: Samsung and SK Hynix out of South Korea, and Micron out of the United States. Between them, those 3 giants have held somewhere around 90% of the global DRAM market, largely because the industry's technical entry barriers are so severe that no serious fourth competitor had managed to break through in a generation. CXMT's early years were rough, in the way pioneering a brutally difficult manufacturing process almost always is. The company operated at a loss for years, and as recently as 2023 was posting gross margins in negative territory, essentially selling chips for less than it cost to make them, a common but financially punishing strategy for a young manufacturer trying to build market share and manufacturing know-how before profitability becomes realistic. That changed with startling speed. By the first half of 2026, CXMT was reporting expected profits exceeding $7.4 billion, according to reporting from the Wall Street Journal, a swing driven substantially by 2 forces arriving at the same time: a genuine improvement in the company's own manufacturing capability and an industry-wide memory shortage, driven by the AI boom's voracious appetite for high bandwidth memory that has pushed DRAM prices to levels the industry hadn't seen in years. CXMT now holds an estimated 7.7% share of the global DRAM market, a real, verifiable foothold against 3 entrenched giants that had operated as an effective oligopoly for decades. The IPO itself is worth understanding in some detail, because the numbers involved are genuinely extraordinary even by the standards of a red-hot semiconductor market. CXMT priced its shares at 8.66 yuan, or roughly $1.28, selling nearly 6.7 billion shares, representing 10% of its total enlarged share capital, at an implied valuation of 579 billion yuan, or approximately $85.2 billion. The base offering was set to raise 57.9 billion yuan, close to $8.6 billion, with a 15% over-allotment option that could push the total raise toward $9.8 billion if fully exercised. That fundraising total is nearly double what CXMT had originally earmarked for its planned investment projects in its own prospectus, and it comfortably surpasses the previous record for a Chinese chip company's Shanghai listing, set back in 2020 by Semiconductor Manufacturing International Corporation, better known as SMIC, which raised 53.23 billion yuan at the time. In plain terms, this wasn't just a big IPO, it was the biggest semiconductor listing mainland China has ever produced. The market's appetite for CXMT shares tells its own story about how investors are reading this moment. The retail tranche of the offering was oversubscribed by more than 200 times, and depending on which report you look at, the final subscription figures ranged as high as around 244 times oversubscribed, with the winning allocation rate for individual investors landing around a fraction of a percent, meaning the overwhelming majority of the roughly 9.5 million people who tried to buy in through the retail tranche got nothing at all. Some market observers have gone further still, suggesting that once shares actually begin trading, CXMT's valuation could surge dramatically beyond that initial $85 billion mark, with some investors forecasting a post-listing valuation climbing toward 3 to 5 trillion yuan, somewhere between $440 and $740 billion. Territory that would put CXMT in a completely different weight class from where its IPO priced it. It's worth pausing here to be honest about just how aggressive that pricing already looks by conventional financial measures, because this is exactly the kind of detail that separates sober analysis from pure hype. CXMT's offering price implies a price-to-earnings ratio exceeding 300 times, based on the company's 2025 earnings, and a price-to-book ratio of roughly 5 times. Those are extraordinarily rich multiples for a manufacturing company in a notoriously cyclical, capital-intensive industry. Multiples that only make sense if you believe CXMT's current run of exceptional profitability, driven substantially by an industry-wide memory shortage that has pushed DRAM prices to unusually elevated levels, is going to continue for a long stretch of time, rather than cooling off the way memory chip cycles historically have, again and again, over multiple decades. If that profit run holds, the current valuation might look, in hindsight, entirely reasonable. If DRAM pricing swings back down the way it has repeatedly in the past, an $85 billion valuation could end up looking like exactly the kind of number a frothy, retail-driven market generates in a moment of enthusiasm, one that a more cautious institutional investor base would have priced considerably more conservatively. Now, let's get to the geopolitical heart of this story, because it's the reason a memory chip IPO in Shanghai is generating headlines in Washington rather than staying confined to financial trade publications. CXMT's rise has been unfolding directly alongside years of American export controls, specifically designed to slow China's progress in advanced semiconductor manufacturing, restrictions on the sale of extreme ultraviolet lithography equipment and other advanced chip-making tools that companies need to produce the most cutting-edge processors and memory chips. Those controls have genuinely constrained CXMT in real, measurable ways. The company still lacks access to the most advanced lithography equipment used by its South Korean and American rivals, and it remains years behind in reaching the kind of leading-edge manufacturing process nodes that Samsung, SK Hynix, and Micron currently operate at for their most advanced products. CXMT also has essentially no meaningful presence yet in high-bandwidth memory, the specialized, extraordinarily lucrative memory chips powering the AI boom, a market segment that remains, for now, firmly dominated by its 3 larger rivals. But here's where the ban may be too late. Framing earns real substance rather than just dramatic flair. Export controls were designed to slow China's access to the most advanced chip-making equipment, and by most accounts, they have genuinely done that. What they were never fully able to do was stop China from building an enormous, well-funded, increasingly capable competitor in the less exotic, but still enormously valuable, standard DRAM market, the ordinary memory chips that go into everyday laptops, servers, and phones, rather than the most cutting-edge AI accelerators. CXMT built its capability using process technology that, while behind the absolute cutting edge, was mature enough to not require the most tightly restricted equipment. And it built that capability with the backing of patient, deep-pocketed Chinese state capital willing to fund years of losses before profitability arrived. Export controls constrained the ceiling CXMT could reach. They did not stop the floor it could build, and that floor turned out to be enormous enough to fund an $85 billion public listing, and enormous enough to capture nearly 8% of the entire global DRAM market from a standing start a decade ago. The Apple angle in this story is worth spending real time on, because it's the single clearest sign that CXMT's rise is no longer a purely domestic Chinese phenomenon confined behind restrictions that keep it out of Western supply chains. Reports have emerged that Apple, facing its own memory supply pressures amid the broader industry-wide shortage, has been testing CXMT's chips as a potential supplier, a development that would have been almost unthinkable for a company with Apple's brand sensitivity and its complicated position navigating U.S.-China trade tensions just a couple of years earlier. Corsair, a well-known Western PC components brand, has separately been found shipping consumer memory products built with CXMT manufactured chips. These aren't hypothetical someday possibilities. They are things that are already happening right now, which means the practical, on-the-ground reality of CXMT's market penetration into Western supply chains has, in some limited but real ways, already outpaced the policy apparatus that was specifically built to prevent exactly that kind of outcome. There is also a very specific historical precedent for Washington's current predicament here worth naming directly: Micron. Back in 2023, Micron was barred from selling to certain Chinese state institutions following a Chinese government security review, a move widely read at the time as a warning shot in the broader chip trade conflict, and one that foreshadowed a broader Chinese push to diversify away from Micron and toward domestic suppliers wherever it could. Micron generates significant revenue from Chinese customers, revenue that has been under real pressure precisely because of this shift, a dynamic that CXMT's continued rise is only going to intensify further, since every gigabyte of memory a Chinese company sources domestically through CXMT is a gigabyte it isn't buying from Micron. That's the concrete dollars and cents version of what a too late ban actually looks like in practice. Not a single dramatic moment of failure, but a slow, steady, and by this point, well-documented transfer of market share, revenue, and now public market capitalization from the American company export controls were partly designed to protect toward the Chinese company. Those same controls were partly designed to constrain. It's worth being fair and precise about the limits of this story too, because overstating CXMT's position would be just as misleading as dismissing it. CXMT remains, by revenue and by advanced process technology, considerably smaller and less sophisticated than Samsung, SK Hynix, and Micron. Its $85 billion valuation places it, on paper, in roughly the same market capitalization tier as some of its established rivals, but that valuation is built substantially on investor expectations about future growth and continued elevated DRAM pricing, not on CXMT, currently matching those companies on revenue, technology, or manufacturing scale today. The company is, by its own acknowledgement and by outside industry analysis alike, still years away from closing the gap in high bandwidth memory specifically, the segment of the market currently generating the most attention and the richest margins across the entire industry. And DRAM pricing, historically, is one of the most cyclical boom and bust markets in all of technology manufacturing, meaning the extraordinary profit run currently supporting CXMT's rich valuation could just as easily reverse in the coming years as continue. But set those legitimate caveats against the strategic picture, and the too late framing holds up better than a skeptic might initially assume. Export controls were built around a specific theory that by restricting access to the most advanced chip-making equipment, the United States and its allies could keep meaningful distance between Chinese semiconductor capability and the global cutting edge. That theory has, in a narrow sense, worked. CXMT genuinely does lag behind on the most advanced process nodes, and in high bandwidth memory specifically. What that theory didn't fully anticipate was how much value, revenue, and strategic capability a Chinese chipmaker could build without needing the cutting edge at all, simply by mass-producing ordinary, technologically mature DRAM at massive scale, backed by patient state capital willing to absorb years of losses precisely at a moment when a global memory shortage made even that merely mature technology extraordinarily profitable to produce. An $85 billion IPO, 200 times oversubscribed by retail investors, funding a company already supplying chips tested by Apple and shipped by Corsair, is not the outcome anyone designing those export controls a few years ago was hoping to prevent. And yet, here it is, having happened anyway. So where does that leave the actual honest answer to whether America's ban came too late? It depends on what the ban was actually trying to achieve. If the goal was to prevent China from ever fielding a serious, publicly traded, multi-billion-dollar memory chip competitor at all, then yes, that goal has clearly not been met, and CXMT's Shanghai debut is the loudest possible evidence of that fact. If the goal was narrower, specifically to keep the most advanced chip-making equipment and the most cutting-edge process technology out of Chinese hands, then the controls have had real, measurable success, and CXMT's continued gap in high bandwidth memory and leading-edge manufacturing is proof that a meaningful technological ceiling still exists. The uncomfortable truth sitting underneath this entire story is that both of those things are true at once. A real, still-standing technology ceiling on one hand, and a massive, well-funded, increasingly market-relevant Chinese competitor that built an entire industry beneath that ceiling. One profitable enough, one investor-hungry enough, and one strategically significant enough to command an $85 billion valuation on its very first day as a public company. Whatever comes next in the broader US-China chip rivalry, that specific ceiling, and everything China has managed to build underneath it while Washington was busy trying to keep it in place, is now a matter of undeniable public record, priced, traded, and valued in real time on the floor of the Shanghai Stock Exchange. There's a broader pattern worth naming before we close. Because CXMT's playbook isn't actually a new one, it's a recognizable repeat of a strategy China has used successfully in other industries before. Fund a domestic manufacturer through years of losses using patient state-backed capital, build out massive production capacity even while trailing on the most advanced technology, and wait for a moment when global market conditions, whether a supply shortage, a price spike, or a shift in demand, turn that merely adequate capacity into something extraordinarily profitable almost overnight. Solar panels followed roughly this arc. Electric vehicle batteries followed a similar one. Now DRAM appears to be following it too, and the mechanism each time has been broadly the same. Technology restrictions aimed at the cutting edge leave an enormous amount of room underneath that edge for a well-capitalized domestic competitor to grow into, especially in an industry as capital-intensive and cyclical as semiconductor manufacturing, where the ability to absorb years of losses without needing to satisfy impatient private shareholders is, in itself, a genuine strategic advantage that Western competitors, answerable to public markets and demanding investors from day one, have never had the luxury of matching. That pattern also explains why the timing of this specific IPO matters so much to how the story is being read in Washington and Seoul alike. CXMT chose to go public precisely at the moment when DRAM prices were unusually high, profits were unusually strong, and investor enthusiasm for anything touching the AI-driven memory shortage was running at a fever pitch, all of which combined to produce the richest possible valuation for the company's public market debut. Whether that valuation holds up once the current memory shortage eventually eases, as memory chip cycles historically always have, is a genuinely open question that even sophisticated institutional investors are visibly divided on. But regardless of how CXMT's stock price performs in the months and years following its debut, the capital it just raised, somewhere between $8.5 and nearly $10 billion, is now locked in and available for exactly the kind of continued capacity expansion and technology investment that could help the company keep narrowing the gap with Samsung, SK Hynix, and Micron over the years ahead. That's the piece of this story that no single day's stock price movement can undo. The IPO happened, the capital was raised, and whatever comes next in the fight over export controls, technology ceilings, and global memory chip market share, CXMT now has a public war chest, a public valuation, and a public spotlight that it simply didn't have the week before this listing took place. For Samsung, SK Hynix, and Micron, the practical question this raises isn't whether CXMT can be ignored, that ship has clearly sailed, but how quickly each of them needs to respond, whether through pricing, through further investment in their own next-generation technology, or through renewed lobbying for even tighter restrictions on exactly the kind of equipment access that has, so far, kept CXMT a step behind, rather than fully caught up. For policymakers in Washington, the practical question is whether the current framework of export controls, built around restricting the most advanced equipment, needs a fundamentally different companion strategy for addressing a competitor that has learned to build enormous scale and enormous market value without needing that equipment at all. Neither of those questions has an easy answer, and neither is likely to be settled quickly. But as of July 27th, 2026, one part of the picture is no longer up for debate. China's memory chip ambitions are no longer a private, state-funded project developing quietly behind restricted borders. They are now a publicly traded $85 billion company, priced by global capital markets in broad daylight. And that alone marks a turning point in this story that will be much harder to walk back than any single new policy announcement could ever manage.